Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital, and I am so happy to be here with you guys today. We're going to talk about getting your multifamily property ready to sell. And so that's very important. You think about doing the hard work. If you're a developer, acquiring the land, getting your permits, getting it approved, getting it built, getting it leased. But how do you put yourself in the best position to make sure you're going to get the maximum value when you get ready to sell it? Or maybe you're doing a value add deal and you've done all that work to bring value to that property. How do you make sure you're going to get the most value out of it? So today we brought in an expert, Mr. Tyler Bynum, who's going to talk to us about how to maximize the value of a multifamily development or acquisition, rehab acquisition that you're preparing to sell. But before we get into our conversation today, we have those housekeeping items. Remember to like, share, and subscribe. That way we can continue to bring you content and have these effective interviews that's really designed to educate you about what's happening in commercial real estate and how you can maximize the value of your investment if you are an investor in commercial real estate. So Tyler, thanks for being here with us today.
No problem. Thanks for having me.
Yeah. So Tyler, tell us a little bit about your background and experience. How did your journey into the commercial real estate business area? How did that all begin?
Went to school at University of Arkansas. Played club hockey there on a team, and it was actually one of my roommates' parents was in commercial real estate down here in Dallas, and kind of started shadowing her on what to do, and she's the one that kind of inspired me to get in the business.
Okay. Yeah. So what was attractive about commercial real estate to make you choose this other than something else?
Probably just the fact that there's so many different aspects of the business.
Okay.
The development, value add type deals, leasing, triple net. I was just interested in trying to get involved in everything. I kind of hopped around from industrial to retail to office, and then ended up in multifamily. So it was just kind of a good way to learn business all around.
Okay, yeah, and it is such a very diverse business inside of commercial real estate. But you've focused your career as of late, I guess the last 3 years, on multifamily brokering. Is that correct?
Yes, sir.
Yeah. Now, what is it about that makes selling multifamily that's different from selling retail or office or anything else? What would you say is a key difference with this particular asset class?
I mean, the biggest one is it's the tenant's home. So it's people are living there. It's their livelihood, and there's an importance behind it, and you want to make sure that your tenants have better lives, and you're doing right by them.
Okay, well, very good. And so you've worked for some notable companies in your career. I think you mentioned Stream Realty.
Mm-hmm. Yep.
Is where you started.
Yep, and then hopped over to CBRE after that, and those companies, I was right out of college. I was focusing on the property accounting side, and then at CBRE was doing transaction accounting. So started learning how the money flows in and out of the properties, how does the transaction happen, the closing statements, and so my transition over to brokerage was a little unique. I didn't have that sales background, but I had the numbers background. So it made underwriting deals and helping the sellers prepare to sell a little bit easier when I'm looking at their T12 and whatnot. So it's kind of a unique way to get over to it, but it's paying off right now.
Yeah, and in fact, I think the way that you entered into commercial real estate, especially on the multifamily side, is probably better because at the end of the day, a multifamily property is it's an investment. Like stocks and bonds are investment. In order to evaluate the value of if it's a paper asset or a real asset like multifamily, you have to understand how the numbers work. If you can't understand the numbers, how to understand how the cap rate works with the NOI to create value, how to lower expenses or look at expenses that may seem unusual and be able to discount those out. If you don't understand that, it's hard to as a broker to really add value to your client. Would you agree with that?
Oh yeah, absolutely. I mean, we sell things on an NOI basis, right? So it's all about reducing expenses and increasing income. So taking line item by line item and trying to figure out how to maximize that value.
Yeah. So that advantage for you when your client comes to you with their multifamily property to sell, what is the first thing that you ask for in order to prepare their property to sell?
I do a T12 financial statement, so trailing 12 months. But I'm really, really focused on probably the preceding 3 months.
Okay.
How the property's trending. Maybe we get that NOI on a 12-month basis because that's what a lot of lenders and stuff will look at. But when I'm trying to sell the property, I'm trying to sell it on a story, whether it's upward trending or downward trending. And so the last 3 months are probably the most important.
Okay, good. Now, and for the benefit of our audience, we're going to take some of our industry terms and we're going to break them down for you. We use NOI, but when we say NOI, we're referring to
net operating income.
Right. And now, how's the net operating income different from the net income?
Net operating is just operating expenses only. So it's what the property is producing before the loan, basically. And that's the best way I can kind of
And that's an excellent way of explaining that. So you have your revenue, which you get from your rent and maybe other services that you collect. You have those operating expenses, which your loan payment is not an operating expense. So we don't include that in the expense. No. We don't include the interest for the loan payment in the expense. If we did include the interest in the expense and maybe depreciation and amortization, it's not net operating income, it becomes net income. And that's the difference between net income and net operating income. But when we're trying to look at the value, we look at the net operating income. And then how do we use the net operating income to establish the value of the property?
So each market or sub-market, I guess, which is sub-market would be basically a city within a city. You break that down by they're applied cap rates. Those cap rates are tied to various things like population increase, interest rates, and vice versa. Just how popular that market is and what the buyers are. The buyers pretty much determine what the cap rate is, and then we apply that cap rate to the NOI. And then that's when you get the value. Okay,
very good. So when we divide the NOI by the cap rate, then that's going to give us our value. And so now for a broker, your primary job when that potential seller comes to you is to maximize the value that they're going to get for that property, correct?
Yep.
Now, what are some of the things that if you were to able to coach and encourage prospective sellers out there. They have assets they're looking to sell. And obviously, the more you sell it for, the more money you make. So your interests are aligned. Okay? But what advice would you give them to help you maximize the amount you can get for the sale of that property?
Like I said, that to go back to the preceding 3 months is crucial. We look at whether the things like the rent or the occupancy is trending, or right now, I mean, with the big thing with COVID, with value add projects, is a lot of the issue is collections. You might be able to charge $1,000 a month in rent, but are you collecting that? And are those tenants able to keep paying that and making sure that they're not 60, 90 days behind their rent?
Right.
And so that's the first thing we look at as an income basis. Then we break it down to what you mentioned earlier about other income. That's things like parking, pet rent, valet trash, just little types of things like that maybe the seller isn't adding into there yet. And every little $20, $30 a month that the seller can add in when we're about taking to market, you apply that cap rate to that little amount can increase the value by hundreds of thousands, if not millions on some size deals.
Okay, good. So you're able to help analyze and evaluate their business plan, and if there are opportunities to collect income by providing ancillary services, you kind of help them see how they can do it.
Yep.
And then you'll work with them to kind of build up that that NOI over that 90-day period, and that allows you to take this thing to market and maximize the value.
Correct. Yep.
Okay, very good. So now let's say that you have a client who is doing a real estate development, ground up development, and they know they want to sell that property. At what point do you engage with that prospective seller in getting their property ready to sell? Is that months away, or is that only when the property is stabilized? Where do you like to come in?
So my recent project, I guess, was a new development. I think I was hired probably about 5 months before the certificate of occupancy.
Oh, wow.
It's a little early. I mean, those first couple months didn't really have to do too much. A lot of times developers kind of have their plan and process. But what that allows me to do is get my marketing materials ready, maybe really study that sub-market of the city, the population growth, the rents of the other properties, secret shop the other properties around the area, come out with my videography team, the drone videos, and just kind of, really kind of prepare that marketing packet and my story. When we get, so that's, the first 2 months of the 5, right? You hit 3 months out. Well, now your story's starting to develop. Your inspections are starting to happen, the final inspections, and you're kind of just waiting on the city on some things, right? And trying to get that certificate of occupancy, which means the tenants can officially start moving in. And there's buyers out there for all stages of the product there. So about 3 months out, we'll start taking it to buyers. And we'll start telling them, hey, we're 3 months out. Here's the projected rents that we're going to try to get. And you kind of word it as, you're going to buy a 0% occupied deal at this point. So there might be a little bit of wiggle room in the price. But as we start leasing this up, that price is going to go up. So then it kind of gives that buyer an incentive to get in early. And then that could align with the developers. If they have another project lined up, maybe they need that capital early, and that's something they want. Or if they're really trying to maximize the value, we'll work with that developer to say, hey, no, let's just wait till we get to 30% occupied or 50% occupied, whatever that number is. And then that's when we'll try to land the transaction.
Okay, good. Sounds really good. So now is the process different when it's a value add type situation? Because I would think they're wanting to get in and out pretty quick.
Yeah, development, I said, 5 months before, right? On average, but value add, maybe a month. Sometimes 2, right? Because I talked about those 3 months. So if you're an experienced seller and you know what you're doing on the trailing 3 months, maybe you didn't need that consulting process of getting your property ready to sell. You're just picking between your top favorite brokers and rolling with it.
Right.
So that's a pretty quick process. Maybe even just a couple weeks. But if it's more of a, hey, I want to hit this price, but I know I'm not quite there yet. Maybe we'll get hired 2-3 months early and help them get that plan ready. Maybe help them reduce some of their expenses and take more of a consulting role to get their price that they need.
Okay, well, very good. So now, what is the I guess the pool of buyers? What does that look like today? Are there? I know at one point there were significantly more buyers than there were assets to sell. What's happening now that rates are going up and things? Are you still seeing that pool of aggressive buyers still out there, or what's happening today?
Surprisingly, yes. I was a little, everyone was a little nervous at first on the sell side of what was going to happen. I think buyers are getting excited almost. It's kind of settling the sellers down on their aggressive pricing a little bit. But another thing that's happening is institutional money starting to roll in a little bit more. That institution money has been sitting on the sidelines for a while, waiting for this moment. And so the competition there is going up. Keep in mind those institutions need larger assets.
Right.
So those 150, 200 unit deals, those still have great buyer pools. Right. Start getting in the lower unit counts, maybe those buyer pools have kind of shifted back or holding back a little bit, but the larger deals are having no problem selling.
Okay, very good. So, and of course, as a developer, we always want to maximize that and try to cater to a certain group. What would you say? There are several. We can group potential buyers in several different groups. We talked about institutional. We talked about syndication groups that come in and buy. We talk about the individual investors. What group would you say in the multifamily arena is probably most aggressive right now?
The institutions.
Institutions.
Probably. Yeah. I mean, they have, with the interest rates going up, if you really want to maximize your leverage and get a 75, 80% loan, you're going to get a higher rate. But if you have that cash sitting aside, you can drop that leverage down to, 55, 60%.
That gives them a big competitive advantage.
And then you can drop that interest rate down and be really aggressive on the price.
Wow. What have you seen institutions do of late to make sure they win a deal? Is that just how are they structuring their offer to make sure when they go into a deal, they're going to win that deal?
Non-refundable earnest money. Yeah. So what we're seeing is, these institutions or family offices out of, normally right now it's been New York or Florida, headed to Texas. What they're coming doing and they're putting in a significant amount of money up front, non-refundable the day the contract signs. And that's kind of locking in them on that deal. That also potentially, as a seller, if you're selling a deal for $20 million on the market, but an institution comes in with 19, but it's going to put, $200,000, $300,000 non-refundable on that first day, you might take that $1 million discount because you got a serious buyer. You got a solid
buyer. Yeah, makes a lot of sense. So now your job is preparing your client to sell to those buyers, right? Is there any specific advice that you can give to, if you're speaking with your clients right now, your client pool, right? And you're going to give them advice that's going to allow them to maximize the sales price. What advice would you be giving them right now?
It's the broker in me speaking, but I would say sell now. Okay. I know the rates just jumped again, but the
75 basis points.
Talks are they're jumping again.
Right.
And then on top of that, take interest aside, property taxes are increasing on a yearly basis. Property insurance is increasing on a yearly basis. Okay. And you have interest, tax, and insurance are the three largest expenses on a property. Well, if those are all going up, Dallas, Houston, all these markets can have great rent growth, but eventually those expenses are going to catch that rent growth and you're going to start losing value on your property.
Right.
So it's just, people are up against the clock, and I think the longer you wait, the more that value is probably going to go down.
Yeah, and that's the interesting thing. We had a guest on the show here, and our cap rates, we have decently aggressive cap rates. We have very high demand for housing, no matter where it is. Things are getting leased because we just have a demand for housing. But our cap rates are in that, what would you say, 5 to 6 range right now?
I'd say for the 80s type, 90s, that value add product, probably 5 to 6. Those new Class A product, you could argue 5 to 4.5. Get a little bit more aggressive, just because, like you said, it's attracting the institutional buyers, and there's such a need for housing, and those are higher rent places, so that rent offsets those expenses I was talking about.
Yeah, and so this particular guest, they were investing in Arizona, where the cap rates are 3s and 4s, and you're like, well, man, how are you going to get value there? But what he mentioned was they don't have the property tax expense, the insurance expense is not as high, so those expenses are lower. So even though the cap rates are smaller, because their net operating income is a little bit higher, it kind of balances out, and they're getting that. So that's an interesting point that you bring out at sell now, because taxes are going up, insurance premiums are going up, and so if you want to maximize value now, you want to do it before those operating expenses get too high, right? Now, you talked about a little bit the ancillary services that an owner can add to their property to increase its value. You mentioned pet fees, valet garbage. Or is there anything else? What creative things have you seen owners doing to maximize that revenue on their property?
Your revenue. We've seen smart home packages basically coming into apartments, internet packages, basically where an owner can group an an internet policy kind of over the whole property, and then bill back those tenants $30 a month or something, and they might be netting $10 a month on each unit. Little things like that. The pet rent's really big. The first floor, just extending out your patios and getting that extra $20-$30 for an extended patio for your pet, a little grass area, especially with COVID, people are staying home a lot more. So the more outdoor space, the better. And then obviously adding, things like amenities and everything. That's not true income, but you can justify your rents a little bit more when you're beefing up those amenities.
Okay, very good. So that's some really good advice. And now, what markets do you generally serve? Are you mainly in Texas, Dallas-Fort Worth?
Pretty much all over Texas. We have a team of 5 of us on the multifamily side. We're based out of Frisco, but most of the deals and activity we've seen has kind of been in the Houston or San Antonio markets lately. Austin and DFW is getting pretty expensive. And so those cap rates you were talking about, right? Those Dallas markets, you're pushing four-ish cap rates, and it's getting tough on the buyers right now with the rates going up. But the Houston deals, it's kind of a higher cap rate, so the interest isn't having as big of an effect yet. So it's kind of just all the 4 major cities in Texas.
Yeah. And there's still very, very high demand.
Oh, absolutely. Yep.
Well, that's great. So, this has certainly been a wealth of information. And Tyler, worldwide commercial focused on multifamily. We have his information up. If you want to contact him, if you want to just pick his brain for more information, or if you have a property that you're thinking about putting on the market, be sure and give him a call. But we want to thank you for being on our show.
Thanks for having me.
And, as things continue to develop in this crazy market, love to have you back and talk about other things.
Yeah, absolutely. It's changing weekly, so
Absolutely.
just let me know when.
All right. Well, thank you so much.
Thank you.